Gold and silver, are they just fair weather friends or do they have a long-term role in your portfolio? Let me tell you as a friend, sometimes they're like that toxic ex. They come back strong when things go bad, but the moment life gets stable, they ghost you. Welcome to another shining episode of Wealth Waltz with Valance, the show where you and I will waltz our way into the mysteries of building real wealth, one episode at a time. I'm your host Sandeep Wal, the man from Motilal Oswal, and I just heard that you have finally decided to invest in gold right at the peak. Congratulations! You just became the last person to enter a party when the DJ is packing up. Gold and silver are everybody's favorite safe haven assets, but let's be real. Most people only remember them when the economy is burning. And the rest of the time, they're like that distant cousin you only call when you need money. They spike when the markets crash. By the time you FOMO your way in, guess what? The rally is almost over. Ouch. So what's the deal? Why do gold and silver act like that 1x? Hot and cold depending on the mood of the economy? If they don't even pay dividends, why do people keep holding them? And if stocks are the GOAT for long-term investors, why do one even need gold in your portfolio? So buckle up because we're about to break down the shiny mystery called gold and silver. Because gold and silver are also like that one loyal friend who shows up when things go south. Economy crashing, they are the heroes. Stock market booming, they get forgotten like that distant cousin. But why? Why do we display such mood swings for gold and silver? Let's break it down. The first thing that answers this mystery is the inflation and currency interplay. Inflation is like that annoying guest who eats everything at your party and leaves you with scraps. When prices rise, your money buys less, unless of course you are holding gold and silver. History proves this. In the 70s, inflation went crazy and guess what? Gold also soared. Same thing happened in 21-22 when inflation made a comeback. Basically, when stocks crash, feeling like monopoly money, gold and silver step in as the real most valuable players. The second factor are the economic and geopolitical uncertainties. Recession, war, financial market crisis, whenever the world is in a mess, investors panic buy gold like it's the last pack of toilet paper in 2020. 2008 crisis, gold shined. 2019 COVID crash, gold did it again. Because when stocks feel like a gamble, gold feels like a safe bet. And if the world looks like a Netflix apocalypse movie, gold and silver are your survival kits. The third one are the interest rate. Gold is like clingy. It doesn't like competition. The moment interest rates go up, people start buying bonds and FDs instead of gold. Why? Because they actually pay interest. And when the rates go low, gold parties hard. Like in 2009-2011, when the rates were low, gold went up. Gold loves low rates but gets jealous when bonds start offering better deals. The fourth factor is the US dollar and the central banks. Here is a little secret. When the US dollar weakens, gold typically gets stronger. It's like an inverse relationship. If one falls, the other one rises. It happened in 2019-2020 when the dollar struggled, central banks started hoarding gold and the prices skyrocketed. So next time you hear dollar falling, just remember gold's probably flexing in the background. The fifth factor is the market sentiment and speculation. Last but not the least, FOMO. When the economy is shaky, everyone rushes to buy gold and prices shoot up. But when stocks are thriving, gold is left swiping on Tinder for new investors. 2011, gold peaked. Then what? Stocks came back and gold went into hibernation for years. Moral of the story? Gold and silver thrive when fear is high, but lose their shine when optimism returns. So are gold and silver worth holding in your portfolio? Well, they aren't income generators, but when the world is losing its mind, they are the stability your portfolio might need. Just don't be the last one buying when the party is almost over. So gold and silver, they just sit there looking pretty. No interest, no dividends, no passive income. It's like buying a supercar that you can't even drive. So why do investors still hoard them like it's the last piece of pizza at a party? If they don't pay you, why should you pay for them? Well, my friend, let me tell you, gold and silver may not give you a paycheck, but they sure know how to save your financial life when things go south. Let me tell you 4 amazing things that they do for your portfolio. The first one is portfolio diversification and risk hedging. Gold and silver are like those reliable friends who show up when your so-called besties bail on you. Remember 2008 global financial crisis? Stocks crashed, portfolios crumbled, but gold was out there holding fort like the true most valuable person. Moral of the story? When the markets panic, gold and silver are your safety net. They hedge against volatility like a good insurance policy, except without those annoying monthly premiums. The second role that they play is the protection against inflation. Inflation is like that sneaky subscription fee that keeps going up every year, except it's your entire cost of living that's rising. Since 1971, the dollar has lost almost 85% of its value. Meanwhile, gold was just chilling, gaining value like a fine wine. So when cash starts feeling like play money, gold and silver keep your wealth intact. It's like putting your savings in a vault that time and inflation finds it very hard to break into. The third role is the crisis insurance. Gold comes to the rescue when war, recession, financial meltdowns trouble your portfolio. When the world is on fire, gold and silver are your firefighters. Take 2022, for example. The Russia-Ukraine crisis shook the global markets. Stocks, unstable. But gold was out there flexing, proving why it is ultimate break glass in case of an emergency asset. So yeah, you don't need gold every day, but when you do, you will be very glad you had it. The fourth and a very, very important role it plays is the store of value because of its limited supply. Fiat currency, government can print it endlessly, but gold and silver, limited supply. Unlike paper money, which loses value faster than your New Year's resolutions, gold and silver are long-term stores of wealth. It's simple. Fiat currency depreciates, but gold and silver hold their value. That's why central banks stockpile them instead of, Bitcoin. But do gold and silver generate income? No. But do they protect your wealth, hedge against inflation, and shine when markets collapse? Very surely. And trust me, sometimes survival is more important than a paycheck. Alright, let's be real. If you had to pick a long-term investment, would you rather choose something that grows exponentially, like stocks, or something that mostly just sits there looking shiny? Exactly. That's why equities outperform gold in the long run. But does that mean gold is useless? Not even close. Just like you don't eat only pizza as much as you would love to, you shouldn't try to rely only on stocks. Diversification is the name of the game. How do we get that right? Let's look at 4 scenarios. The first one is let's compare the long-term performance of gold versus equities. Since 1980, the S&P 500 has delivered about 10% annualized returns. Gold, about 5 to 6%. Translation, if you invested in stocks, your money would have multiplied faster than gold. Gold might have some flex, but it's not the growth champion here. It's like comparing a sports car to an armored truck. The one gets you rich, the other keeps you safe. The second is let's examine gold's role in a portfolio. Here's the deal. Gold and silver aren't here to make you rich. They are here to protect what you have already made. So a small 5 to 10% allocation to gold can stabilize your portfolio. Think of it like an insurance policy. Nobody buys it expecting returns, but when disaster strikes, you'll be glad you had it. Gold is that one responsible friend who will most probably not let you down in a crisis. The third one, let's look at tactical allocation based on market cycles. Smart investors don't just buy and hold gold forever. They adjust based on market cycles. More gold before recession, less gold during bull runs. It's that simple. Example, before market crashes, gold usually gains demand. But when things recover, it takes a backseat while the stocks shine. It's all about playing the cycles right. The fourth one is crisis protection versus trading for cycles. Now, not all gold investors are the same. Some hold forever, treating it like a doomsday bunker. The others trade based on economic trends. Which one are you? If you just want crisis protection, a small chunk of gold in your portfolio is enough. But if you like timing the market, then you can trade like a pro based on macroeconomic cycles. Either way, it's not an all or nothing game. You don't ditch stocks for gold. You balance both. So how do you invest smartly in gold and silver? Let me take you through the takeaways from this episode. First, Gold typically shines in inflation, crisis, and falling interest rates. Second, it's a hedge, not an income generator. Third, stocks grow wealth, gold protects it. Fourth, a 5 to 10% gold allocation is recommended for balancing risk. And the bottom line, don't ignore gold, but don't bet your entire fortune on it either. It's the seat belt of your investment car. You may not always need it, but when you do, you'll be thankful you had it. And that's a wrap on today's Wealth Waltz with Valance. Invest smart, stay balanced, and may your portfolio always shine. If you enjoyed this episode, hit that subscribe button and comment with your doubts. I'll try and answer as much as I can. I'll see you next time as we keep waltzing towards smarter, wealthier investing decisions. Catch you soon.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.